You know, I've been watching people invest money for a long time now, and I've noticed something that took me years to really understand. Most people think the key to doing well in investing is effort. Work harder, read more, stay up late studying companies, check your portfolio every morning, maybe check it again at lunch, and then once more before bed, just to be sure. And I get it, I really do, because that's how most things in life work, isn't it? You study harder, you get better grades, you practice more, you get better at piano. You put in the hours at work, you move up. Effort equals results. That's what we've been taught since we were kids. But investing doesn't work that way. And that's a hard thing to accept because if effort doesn't win, what does? I'll tell you what I've seen win time and time again. It's discipline. And discipline looks nothing like effort. In fact, most of the time, discipline looks like doing nothing at all. Let me back up a bit. When I started paying attention to markets, really paying attention, I thought the smartest investors were the ones who knew the most, the ones who could rattle off price to earnings ratios and predict what the Federal Reserve would do next quarter, the ones who read every annual report, every quarterly filing, every analyst's note. And sure, some of those people do well. Knowledge matters, understanding matters. But I watched something strange happen over the years. I watched brilliant people, people who knew everything about everything, lose money, not because they were wrong about their analysis. They were often right, but they couldn't sit still. They had to do something with all that knowledge. They had to act on every insight, every piece of news, every shift in the market. And then I watched other people, people who seemed almost simple in their approach, make money year after year, decade after decade, not because they were smarter, not because they worked harder, but because they could wait. That's what discipline is, really. It's the ability to wait when waiting is the right thing to do. Now, our brains don't like this idea very much because waiting feels passive. It feels like you're not doing your job, like you're lazy even. I remember talking to a friend years ago, someone who was managing his own portfolio. He'd call me up, excited, almost breathless. I found this opportunity, he'd say. I've been researching it all week, stayed up until midnight last night reading everything I could find. And I'd ask him, well, what are you going to do? I'm buying tomorrow morning. First thing, a few months would pass. He'd call again, different company, same excitement, same late night, same urgency. And the funny thing is, most of his picks weren't bad. He wasn't choosing terrible companies, but he kept moving, buying, selling, buying something else, responding to news, responding to market moves, always responding. And all that responding, all that effort, it added up to not much. Some years he was up a little, some years down a little, but mostly he was just treading water, exhausted water. Meanwhile, the few positions he bought and forgot about, the ones he didn't have time to tinker with, those did fine, better than fine, actually. They just sat there compounding quietly while he was busy being busy everywhere else. See, the market rewards you for being right, but it really rewards you for being right and then doing nothing. That's the part nobody tells you when you're starting out. They tell you to work hard, study companies, understand value. All true. But they don't tell you that after you do all that work, after you find something good and buy it at a fair price, then your job is to sit on your hands. And sitting on your hands is so much harder than it sounds because something's always happening every single day. Company earnings come out, economic reports, political news. Some analyst upgrades the stock, another one downgrades it. There's always a reason to do something, always a reason to reconsider, to adjust, to optimize. And that voice in your head starts talking. Maybe I should take profits here. Maybe I should move some money over there. Maybe I'm missing something. Maybe everyone else knows something I don't. That voice, it sounds like wisdom. It sounds like being responsible, being alert, staying on top of things. But most of the time, that voice is just fear dressed up as diligence, or it's boredom, which might be worse. You know what's boring? Owning a good company for 10 years. Nothing dramatic happens most days, nothing to tell your friends about. No stories of perfect timing or clever moves, just holding, and boredom is uncomfortable. We want to feel smart. We want to feel productive. We want evidence that we're doing something valuable with our time. So we start looking for problems that don't exist. We start inventing reasons to make changes because making changes feels like progress, feels like we're earning our place as investors. But here's what I've learned. And it took me longer than I'd like to admit. The best investors I've ever known, the ones with the longest track records of actual success, they're comfortable being bored. They're comfortable looking at their portfolio and seeing the same names they saw last month, and the month before that, and the year before that. They're comfortable telling someone who asks what they're buying, nothing right now. Same. Things I owned last year. And people think they're not paying attention. People think they've stopped trying, but they haven't. They're just disciplined enough to know that sometimes, actually most of the time, the right move is no move at all. Now, I'm not saying you never sell. I'm not saying you never buy. Of course you do. But those decisions, when they're good decisions, they come from discipline, not from effort. Discipline means you have rules, not complicated rules, simple ones. Maybe you sell when the price gets so high that it doesn't make sense anymore, when the value just isn't there. Maybe you sell when something fundamental about the business changes, something real, not just a bad quarter or two. But discipline means you don't sell just because the stock went down. You don't sell because you're nervous. You don't sell because someone on television said something that scared you. And you don't buy just because something went up and you feel like you're missing out. You don't buy because everyone else is buying. You don't buy to feel like you're participating. That feeling, that fear of missing out, it's killed more portfolios than almost anything else because it makes you chase. And chasing is the opposite of discipline. I knew a man once, older fellow, managed his own money his whole life, did pretty well. And someone asked him once, how do you decide what to buy? And he said something I've never forgotten. He said, I wait until something's so obvious that I'd feel stupid not buying it. And then I wait a little longer just to be sure. That's discipline. Not jumping at the first good idea, not needing to be first, being patient enough to wait for the obvious, and then being patient enough to let the obvious play out. Because here's the thing about investing, the opportunities, the real ones, they don't disappear in a day. Good companies stay good companies for years. Undervalued situations take time to correct. You have time, more time than you think. But we don't feel like we have time. We feel urgency. Every day we're not invested, the next big thing feels like a day we're losing. Every point the market goes up without us feels personal, like we're being left behind. And that feeling makes us act, makes us do something, anything to feel like we're keeping up. But the best investors aren't trying to keep up. They're not racing anyone. They're just trying to avoid being stupid. And most of the time, avoiding stupid means not acting on feelings. Fear is a feeling, greed is a feeling, excitement is a feeling, panic is a feeling, boredom, impatience, even confidence, those are feelings. And feelings, they change every day, sometimes every hour. You can't build a strategy around feelings. You can't compound wealth on emotions. But you can build a strategy around principles, simple ones. Buy good things at fair prices. Don't overpay. Don't sell just because something goes down. Don't buy just because something goes up. Wait for the obvious. Let time do the heavy lifting. Those principles, they sound boring when you write them out like that. They sound like something anyone could do. And that's true, anyone could. But most people won't, because most people can't tolerate the boredom, can't tolerate looking inactive when everyone around them is busy trading, busy reacting, busy doing something. There's this notion in our culture that if you're not doing something, you're not working. And if you're not working, you're not earning your results. But in investing, the opposite is often true. The less you do, if you've done the right things to start with, the better you tend to do. Because every time you act, every time you trade, there's a cost. Sometimes it's obvious, like fees or taxes. Sometimes it's subtle, like buying at the wrong moment because you felt rushed, or selling at the wrong moment because you felt scared. And those costs, they add up over time. Not in a dramatic way, in a quiet way. A few percentage points here, a few points there. Doesn't sound like much. But compound that over 10 years, 20 years, and suddenly you're looking at the difference between doing well and doing extraordinarily well. The patient investor, the disciplined one, they avoid those costs, not because they're trying to optimize every decision, but because they're making fewer decisions. And fewer decisions mean fewer chances to be wrong. Now, I know what some people are thinking. They're thinking, this sounds passive. Sounds like I'm saying, don't pay attention, don't care, just buy something and forget it exists. That's not what I'm saying. Not quite. You should pay attention. You should know what you own and why you own it. You should read the annual reports. You should understand the business. All of that matters. But paying attention doesn't mean reacting. Knowing what's happening doesn't mean you have to do something about it. most news, most of what happens day to day, it doesn't change the fundamental value of what you own. Doesn't change whether a company is good or bad, whether the price is fair or not. But it feels like it does. It feels urgent. And that feeling, that's what gets people in trouble. Discipline is being able to separate what feels important from what actually is important. And that takes practice, takes time, takes making mistakes and learning from them. I've made plenty of mistakes, sold things I should have held, bought things I should have passed on, acted when I should have waited. And every time, almost every time, it was because I let a feeling override a principle. I felt nervous, so I sold. I felt excited, so I bought. I felt like I needed to do something, so I did something. And looking back, those decisions, they weren't based on analysis. They were based on emotion. I just dressed them up as analysis afterward to make myself feel better. That's something we do as humans. We decide emotionally and then justify rationally. We tell ourselves a story about why we did what we did, a story that makes us sound smart and thoughtful. But really, we just reacted. Discipline is catching yourself before you react. It's noticing that feeling, that urge to do something and asking, is this based on principle or is this based on fear? And if it's fear, if it's boredom, if it's impatience, then the answer is wait. Just wait. The urge will pass, the feeling will fade, and when it does, you can think clearly again. Because clear thinking, that's what you need, not effort, not activity, just clear, calm thinking. And clear thinking happens when you're not emotional, when you're not rushing, when you're not trying to keep up with anyone or prove anything to anyone. I think that's another piece of it. We invest in public in a way. We talk about our investments with friends, with family. We see what other people are buying. We hear about their wins, and we want to have wins to talk about too. So we make moves that look impressive. We buy the hot stock. We make the bold call because we want a story. We want to be able to say, at dinner, I got in early on that. I saw it coming. But the best investors, they don't have those stories. Or if they do, they don't tell them because they're not investing to impress anyone. They're investing to build wealth slowly and steadily in a way that doesn't make for exciting conversation. Discipline is being okay with not having stories, being okay with being boring, being okay with someone asking what you're invested in and giving them the same answer you gave them. 2 years ago, that's not exciting. I know it's not, but it works. And it works because time is on your side if you let it be. Good businesses grow over time. Earnings compound, value gets recognized eventually. But you have to give it time. You have to be patient enough to let years pass without panicking, without second guessing, without needing constant validation that you made the right choice. That's discipline, and it's rare. Rarer than intelligence, rarer than hard work, rarer than good ideas, because discipline requires something that doesn't come naturally to most of us. It requires being comfortable with uncertainty, comfortable with not knowing what's going to happen tomorrow or next month or next year, comfortable with the possibility that you might look foolish for a while before you look smart. And most people, they can't handle that. They need to feel in control. They need to feel like they're managing risk, staying ahead of problems, being proactive. But in investing, trying to control everything usually means controlling nothing because the market doesn't care what you need. It doesn't move on your schedule. It doesn't reward effort or urgency or clever timing. It rewards being right about value and having the patience to wait for the market to agree with you. Sometimes that wait is short. Sometimes it's long. You don't get to choose. All you get to choose is whether you'll stick around for it. And sticking around, that's the discipline part. That's the part that separates people who do okay from people who build real wealth over a lifetime. Because real wealth, the kind that lasts, it's not built on effort. It's not built on being busy or being smart or being the hardest worker in the room. It's built on patience, on discipline, on doing the right things and then having the wisdom to stop doing things. There's a quote I like, I don't are. Remember who said it first. But it goes something like, the stock market is a device for transferring money from the impatient to the patient. And that's it, really. That's the whole game. Are you patient enough to wait while everyone else is busy? Are you disciplined enough to hold while everyone else is trading? Are you calm enough to do nothing when nothing is the right thing to do? If you are, you'll do fine. Better than fine, not because you're smarter, not because you work harder, but because you understand something most people never learn. Now, let me tell you about something else I've noticed over the years, something about how we measure success in investing. Most people, they measure success by what happened this year or this quarter or even this month. Did I beat the market? Did I make money? Am I up or down? And I understand why. We want feedback. We want to know if we're doing it right. We want validation. But that's not how investing works. Not really, because the best decisions, the ones that really matter, they don't pay off right away. Sometimes they don't pay off for years. I remember buying into a company once, a good company, selling at what I thought was a fair price. And for 2 years, nothing happened. The stock just sat there, went down a little some months, up a little others. But mostly it just existed. And I'd look at it in my portfolio and think, did I miss something? Is this a mistake? But I'd go back and read the annual reports, look at the business, and nothing had changed. The company was still good, still doing what it was supposed to do, making money, serving customers, building value. The stock just hadn't moved yet. The market hadn't noticed yet or didn't care yet. And then in year 3, something shifted, not in the company. The company was the same, but the market's mood changed. And suddenly everyone wanted Ed to own what I'd been holding all along. The stock doubled, then doubled again. And people would ask me, how did you know? What made you buy it? But I didn't know. I just thought it was a good business at a fair price. And I was disciplined enough to wait for the market to figure that out. That's the thing about discipline. It doesn't give you certainty. It doesn't tell you when something's going to work. It just gives you the patience to let things work when they're supposed to. And that patience, it's tested constantly. Because while you're waiting, you're watching other things go up, other stocks, other sectors, other strategies. And you're sitting there with your boring portfolio and it feels like you are missing out on everything. That's when discipline is hardest, not when things are going badly. When things are going badly, at least you know everyone's in the same boat. But when things are going well for everyone except you, when everyone else is making money and you're just waiting, that's when it really hurts. And that's when most people break. They sell what they own, the good stuff they bought at fair prices, and they chase whatever's working right now because they can't stand the feeling of being left behind. And sometimes they get lucky. They chase the hot thing and it keeps going up for a while and they feel smart. But more often, they're late. They're buying at the top. They're paying prices that don't make sense because everyone else is paying those prices. And when the momentum stops, when the music stops playing, they're the ones left holding something overpriced, and then it goes down. And they panic, and they sell at a loss, and the cycle starts over. Meanwhile, the disciplined investor, the boring one who didn't chase anything, they're still sitting there with their good companies bought at fair prices. And eventually their turn comes. The market gets interested in what they own. And when it does, they've made money while everyone else was busy losing it. That's the pattern I've seen play out over and over. The disciplined investors, they don't win every year. Some years they look foolish. Some years they underperform. But over time, over decades, they win. And the active investors, the ones who work so hard, who put in so much effort, they have great years and terrible years, big wins and big losses. And when you add it all up, they don't come out ahead. They just worked harder to end up in the same place, or worse. There's another thing about discipline that I think is worth mentioning. It's not just about controlling your actions. It's about controlling your attention. Because where you put your attention, that shapes how you think. And how you think determines what you do. If you're checking your portfolio every day, you're training yourself to think short term. You're training yourself to react to noise. Every little move feels significant. Every piece of news feels urgent. But if you check once a month or once a quarter, suddenly the daily noise doesn't matter anymore. You're seeing the bigger picture. You're thinking in longer time frames. And thinking in longer time frames makes it easier to be patient. The disciplined investor, they're not checking stock prices every morning. They're not reading every article about every company they own. They're not watching financial television or refreshing their brokerage app, not because they don't care, but because they care about the right things. They care about whether the business is doing well, whether management is making good decisions, whether the fundamentals are intact, And those things, they don't change day to day. So checking day to day doesn't help. It just creates anxiety, creates the feeling that you should be DOI something. So they control their attention. They direct it toward what matters and away from what doesn't. And that control, that's a form of discipline too, maybe the most important form. Because if you can control your attention, you can control your thoughts. And if you can control your thoughts, you can control your actions. And if you can control your actions, you can be patient. You can wait. You can let discipline do its work. I've watched people struggle with this. Good people, smart people, people who understand investing intellectually but can't implement it emotionally. And the difference always comes down to discipline. Some people have it. Most people don't. And the ones who don't, they know it. They can feel it. They know they're acting on emotion instead of principle. They know they're chasing instead of waiting. They know they're being impatient, but they can't stop. Because stopping requires something harder than starting. Stopping requires sitting with discomfort, sitting with boredom, sitting with uncertainty. And that's not something you can learn from a book. It's not something someone can teach you. It's something you have to practice, something you have to develop over time through experience, through mistakes. Every time you feel the urge to act and you don't act, you're building discipline. Every time you watch something go up without you and you don't chase it, you're building discipline. Every time you hold something while it goes down and you don't panic, you're building discipline. It's like a muscle. It gets stronger the more you use it. But you have to use it. You have to practice. And here's what's interesting. As that muscle gets stronger, investing gets easier. Not because the markets get easier, they don't, but because your relationship with the markets changes. You stop seeing them as something you need to beat. You stop seeing them as something you need to predict or outsmart or time. You start seeing them as something you can participate in patiently, without drama, without urgency. You start seeing your job not as making things happen, but as letting things happen, not as forcing results, but as allowing results to unfold in their own time. And when you see it that way, the whole thing becomes simpler, not easy, but simpler. You're not trying to do more. You're trying to do less. You're not trying to be clever. You're trying to be patient. You're not trying to beat everyone else. You're trying to avoid beating yourself. And that shift from effort to discipline, from activity to patience, that's what changes everything. Because once you make that shift, you're not fighting anymore. You're not fighting the market. You're not fighting other investors. You're not fighting yourself. You're just doing what makes sense. Buying good things at fair prices, holding them, waiting, letting time work for you instead of against you. And over the years, over the decades, that approach, it builds something real, something that lasts, not through brilliance or hard work or perfect timing, but through discipline, through the willingness to be bored when bored is right, to be patient when patient is right, to do nothing when nothing is right. And in the end, that's what separates the investors who build lasting wealth from the ones who just stay busy. It's not intelligence, it's not effort, it's not luck, it's discipline. Quiet, boring, unglamorous discipline, and that's enough. That's more than enough.